On this episode, you're going to be hearing about RSUs, something that a lot of employers are setting up for their employees to keep them stuck at the job so you don't leave early. They call it bonus structures, but we're going to be breaking it down with our guests. You guys are invited to a new educational series. We're going to be doing one webinar a month on the third Saturday of the month, right around 10 a.m. Pacific time, which is a little early for folks like yourself in Hawaii, a little early for me, but I'm going to get up, give a little presentation for you guys to further help your education through this passive investing world, answer any live questions, and really make it a point to catch everybody up to speed. You guys can get more access to that at simplepassivecashflow.com/events. But here's the show. What's up, Simple Passive Cash Flow listeners? Now, if you guys ever wondered who the heck is part of our group, I would say at this point, we've got like almost 1,000 investors who've dropped 50, 100 Gs with us, which is just crazy and absurd to me. I tell my family this all the time. And more than that, I think there's at least there's 10,000 plus people on our email list. And there's probably another double that of you guys who I call lurkers out there who've been listening to this show for the past few years, haven't joined the club. More importantly, haven't booked a call with me. I want to know who you guys are. We're real people out here. Join the clubs and then, book that free onboarding call. Most of the people I would say are dudes, 80%. We do have some gals within the inner circle family office. A lot of you guys, majority are represented by the state of California, and that puts us most regionally is in the Bay Area. And therefore, we all know it's tech. Some strange reason people think I'm in tech because maybe I'm Asian and I don't know, I'm from the West Coast. I was from Seattle, but I was a civil engineer. We did construction management, but I'll take it as a compliment. But anyway, this episode today is going out to our techies out there, those of you guys who work for Facebook, Microsoft, or startups, and the world of RSUs and equity working in startups, putting a little bit more sweat equity, less compensation for that pop at the end. And it's very rare, but I've seen it happen because they joined the family office group because they were wondering what the heck do we do with all our money. So our guest today is Jim Forrest, who works for Trove Partners. So they focus on helping tech founders and tech employees with equity ownership and all the associated relieving stress, uncertainty, and time spent around finances. So this is a topic. Thanks for jumping on. I really appreciate it.
You're welcome.
But I really wanted to, a lot of my investors talk to me about this and I understand it, but instead of just talking out of my butt, right, and not knowing it, I wanted to bring you on and learn it for myself. And I know a lot of our investors who, again, so we have some investors in their 50s and 60s. They have young kids that are working in these tech companies and taking less compensation than they should because of they want this equity. But let's start off with there, right? Like kind of speaking to the moms and dads out there, like what are RSUs and how are these things kind of structured essentially in a nutshell?
Well, an RSU is a restricted stock unit, and it's typically a form of ownership in a publicly traded business that is given to employees as a form of compensation.
Let's use some spitball numbers here. I guess where some of the white collar tech workers are getting laid off nowadays, which I call it's about time for them, right after the pandemic, where they're unscathed. But what's an average guy out of college making who has a computer science degree from a halfway decent, like a UW or one of those types of schools? Making, like,
let's say a couple $100K, can be $200-300K out of the gate. And then not all of that is typically cash. A portion of that is RSU. So let's just use round numbers for an example. Let's say it's 100K, and out of that 100K, 80K is cash. The 20K is RSU. And the way that the RSU works is that it's going to vest over time. So the engineer doesn't get that amount right off the bat. He has to wait, or she has to wait 1 year, a second year, third year, fourth year, if the vesting schedule is 25% per year. There are other vesting schedules out there that we don't need to get into the specifics, but essentially it takes time for the employee to build the ownership in the company as they're working there over time.
Sounds like a sick, twisted way to keep people at their jobs for them, prevent them from jumping. It's like the whole 401k. Like most companies, it takes you 5 years to get the full vesting or get the full amount or the match up value.
RSU is quite different than 401k. 401ks are typically offered by all companies, whereas RSUs are only a small subset of companies out there. But as to your
Same
point, the
same premise,
RSUs,
right? Like it's incentivizing the person to stick around.
an RSU will, because they're proverbially the golden handcuffs, so to speak. Whereas 401k is investing for someone's long-term retirement. And if they were to leave that job, they can roll that with them. Now, the vesting requirements that vary by business, but they're not as aggressive as the vesting requirements for RSUs.
So what I'm talking about is that portion where they match you and they might do dollar for dollar match. That's what I'm calling, but that's a very small portion, maybe like at the end of the day, under 5% of your total compensation, where you're saying with these RSUs on the light end, it's like at 20% of total comp.
Yeah, it could be more depending on the level and the company and how organizations are structured. As you said, it seems like it is a form of way to keep people there, because if you imagine the RSUs are vesting year after year, but in year one, and then there's year two. So you get another chunk of RSUs, and then it's this sort of continuing cycle, which if a stock does well, a company does well, it's great for the employees that work there, but it leads to maybe someone staying there for a while, maybe not as long as they would have liked, and to pursue something differently with their career.
I think another thing it produces is people will add those RSUs in and maybe even perceive that they're going to be worth 4x in 5 years based on past performance. And it can lead to, from a lot of younger people going to jobs or even colleges, a lot of it's like ego driven by prestige, where I think a lot of the people in our group gotten over that. They're like, screw it, give me my passive cash flow and I'm out. I'm out of this nonsense game. But for some of the younger guys, this is the games you have to play, and these are games, or you have to learn the game. But are RSUs available? Or are they typical for like even the larger companies? I guess like a Microsoft or.
Oh yeah, definitely. Yeah.
So it's not really a big cap tech company or a new startup. It's RSUs are everywhere, but just different. Like, what does it range for like a startup type where.
That's where there's a difference. RSUs typically are for publicly held or publicly traded companies, whereas with startups that are privately held, whether they're seed, Series A, Series B, et cetera, those ownership is the way the ownership is structured is usually through options, through stock options. So that's a much different animal than an RSU, because with an RSU, the 20% of your salary, you know what that's going to be and how it vests. Whereas the stock option has two decision points around it, is what's called the price that you're granted. And then there's an exercise price where you can exercise the price depending on the difference. So I'll give you an example. So let's say you work at startup company ABC and you are granted stock options. Your strike price is $1 per share. You have 10,000 shares. A couple of years in the startup, it gets sold. It's sold for $10 a share. You recoup that difference of the $9 from the share price where it was sold, from your exercise price of one times I believe I said it was 10,000 shares. So you make $90,000 right away. Obviously, there are tax implications depending on the type of option. There's two different types of options and holding periods, et cetera, which is rather convoluted.
Yeah. I'd like to dig into that just so people are aware of it. But the option is, it requires like that IPO date, right? The IPO date is very booms. It's a huge range, where RSUs are a little bit more, even in the tech worlds are very volatile stocks. Still trades within a reasonable band, plus or minus 50%, if you call that reasonable. But it trades within a reasonable band, where the IPO date can just be anything and everything, or lack thereof.
Could be an IPO, but it also could be a merger. For example, the privately held company could be bought by a larger business, and it's not being traded on the public markets. It's actually being bought by a larger competitor. So that when reading through option agreements, that's known as a liquidity event. So your merger, acquisition, IPO, or other, depending on the language in the documents. But the way that it works is there's two different types of options. There's incentive stock options called ISOs, and then there's non-qualified stock options called NSOs. And each of those have different tax treatments around that. I'm not sure if you want to get into the nitty gritty.
Yeah, I mean,
of the
that's how
taxes
we get
around
into here. We don't skim the surface on it. I mean, at the end of the day, I think the problem with this is nobody really talks about it. So it can be confusing. But yeah, let me just break it down slowly. The
Okay.
first one, let's just use the example, right? I slave away at this company for 5 years. They pay me 50 grand to live with some other buddies. And it's time to IPO or merge. And my ISOs like 10Xs, how is that treated as tax from a tax perspective?
Okay, so when you're granted the ISO, there's no tax implication whatsoever. When the option vests, which means you have the option to exercise it, there are no tax implications there. However,
It's
when you
not taken as income personally, is it?
not on the vesting, no, not on the vesting, but on the exercise, when you say, okay, my options, going back to our previous example, are strike price of $1, I could exercise them at 10. That's what's known as the exercise. So you're essentially exercising them. And then at that point, with an ISO, there's two different paths here in terms of the holding period. So let's go with the qualified disposition, which means you essentially own it for a lifespan of more than 2 years. The grant date, excuse me, the vest to exercise is 1 year, then the exercise to sale is also 1 year. So when you do that, when you exercise that, there could be a potential alternative minimum tax, and that all depends on your tax situation. When you do sell the options, the shares that were granted from the options, you could either have a capital gain or loss depending on the stock price. And you could also have an AMT credit for the AMT that you paid previously to that.
Okay.
So it gets pretty convoluted. On the other side of the ISOs, it's called a disqualified disposition, which means you don't meet the 2-year requirement. You sell it or you exercise it with before that 1 year window for each decision tree ends. And you need to pay ordinary income tax on that when you exercise. And then on the sale, it will be either a capital gain or a capital loss, depending on the share price. So it gets complicated. I advise people to, hey, let's sit down, let's talk about this, let's draw it out, actually see how it works and what the numbers are, because trying to think about it conceptually is a pretty difficult thing.
Yeah. So the first one, the ISOs, my understanding, and this is something I'm not super familiar with. Like I'm very familiar in ordinary income, 1099s, W2s, and then passive income, more of an expert in that, where obviously we use passive losses, bonus depreciation. But the world that we're talking about today, guys, is it's like ordinary income, but it's known more under the portfolio income realm. It's under that category. And from what I've noticed, there's all these little nuances based on somebody jerking around with the IRS and their stock options and this, that there's these weird things in play, such as this. If you live the simple passive cash flow life and you get the heck out of all these paper assets, which I think are all fake anyway, your life gets so much simpler and easier. You don't have to worry about this nonsense. But I guess what we're trying to do here is you got to understand it to get out, right? But I guess my take on the ISOs, that first one you mentioned, is it's a benefit they've thrown in there for people to stimulate economy, start new businesses, where that second one seems a little bit more punitive, because as soon as you take them, you've taken that as ordinary income and your AGI will go up accordingly. And then again, when you sell it, that capital gain, just like any real estate deal, when you exit 5 years later or whatever, you have to take that.
That all depends on the person's overall picture, their overall income situation, their overall tax situation, et cetera. So there could be offsets, and there could also be a benefit of exercising an ISO early if the share price was a lot higher when you did. And let's say that the difference is that, okay, the taxes are higher, but it was actually sold at a much higher share price. At the end of the day, the person actually did better, even though they paid a higher tax rate. In a way, it's not letting the tail wag the dog. You're not making a decision solely based on the tax implications. You're actually making a decision based on what the company is doing, what its prospects are, and what the valuation of the business is.
And then another thing to keep in mind on top of that, which you're the expert on that, but the way I look at it too is the overall person picture. Where is your adjusted gross income, which is essentially the summation of passive income, ordinary income, and this portfolio income. And there's a few other incomes out there, such as like royalties, but none of you guys are that musically inclined or are in world inventors out there. So none of you guys typically have royalties unless you have an oil rig or something like that, but which some of you guys do, right? Because you're passive investors in oil and gas deals for the tax benefits, which be careful with that is all I got to say with that. But yeah, it might be good to, if your income is low 1 year because maybe your spouse had a kid and not working, it might be a reason to exercise the ISOs, or that is a common another thing to think about.
If you're looking at it from a tax, yes, but that shouldn't be the only consideration with ISOs. For example, if you would have exercised your options at the end of 2021 versus the end of 2022, the share price most likely would have been a lot different for you.
Yeah, tech guys. They all think they know all the algorithm, everything, and they think they can predict the price. But my whole thing is I can't predict the price. So for me, because I'm a dummy, I'm gonna just remove that from the equation. But yeah, if you have a crystal ball out there, guys, cool. Make your own podcast. Tell us what you're investing in. Put your money where your mouth is. Let us know what's gonna happen in 2024. But for the rest of us, that's why I like renting out boxes and being a landlord. But but let's skip over to the other one, the RSUs. How's that one kind of
Yes.
taxed, I guess?
RSU is a little bit more straightforward than the options, which is a good
Yeah.
thing. There's only really one decision point, whereas with options, there's two decision points. So when an RSU is granted, there's no tax reporting. When it vests, you are taxed at your ordinary income tax rate. And there's also withholding tax when the RSUs actually turn into a share of stock. That's what vesting means. And you go ahead and sell them. And keep in mind, there's no exercise because there's only one step with an RSU, whereas options is two steps that involves an exercise. With an RSU, when you sell it, it's either taxed at your ordinary income tax rate if you hold it for less than 1 year, but 1 year or longer, then it's taxed at a capital gain or loss, depending on the share price. So RSU is a bit more straightforward, a bit more easier to understand, a bit more popular with certain companies, especially on the public side.
Yeah, it's more common and like you said, more prevalent of larger companies
Plus,
to
it's
have that.
easier for the companies and their accounting departments to actually keep track of everything. Clearly, there are options available, but it depends on the person's level and how long they've been with the business, et cetera.
And I know why they're doing it, right? To keep people there. If you and I work for Nike and they just gave you 40 pairs of shoes every year, you're like, dude, I don't need these shoes from you guys. I can just pay me my
You'd almost
salary.
get one new pair a week almost.
I know, and that's how like RSUs are, but it is what it is, right? Not like you can negotiate more or less, but
And during a job offer or during a review, depending on
yeah.
there are options,
Okay.
depending on the company,
Okay.
where it's like, hey, I want this percent salary and then this percent RSU, and it's clearly a sliding scale one way or the other. But the one thing to keep in mind, whether it's RSUs, stock options, share ownership, the big thing to keep in mind is how people get concentrated in the stock where they work. And it could be risky. A lot of people read about the Elon Musks and the Jeff Bezos of the world, and they've done well. They've done very, very well for themselves, but they don't hear about the people who haven't done well. And
Yeah.
I have a story of a friend who actually worked at a company. I can't share the name, but he worked at a company and he was waiting until the stock got to $80 a share, and it got to $78 a share. And he was anchored. He was anchored on 80. It's a concept, a psychological concept. He was anchored on that $80 share price. And he waited and waited and never got there. And when they were at a share price of $78 at a high, and now the shares are down to $4 per share. So he lost close to $800,000 by just trying to hold on for that extra $2, which is a cautionary tale for everyone out there listening who is very big on which position they're in.
It's good that you say it because as much as I was just gonna say, this is the classic Enron story, guys, where
Yeah,
they just
yeah.
gave all their employees their own company stock, and then nowadays everybody knows that you don't do that, dummy. What's it like 20% concentrated in your, especially your company, because that's
20,
just
it's very high because one, you're getting a paycheck from them every two
yeah,
weeks. I would say that 5% position in a company high. And that's clearly a rule of thumb. There are exceptions where people are more risk aggressive, or people have certain positions at companies where they're high up and they can't really sell the ownership that they have because they're a leader of the business. So there are exceptions, but generally around 5% is a good rule of thumb for a concentrated position.
yeah. Seems obvious, but now that I realize I'm getting older, there's a lot of people that don't even know what the heck Enron is. Just like my personal experience share when I used to work for a company, now Warren Buffett owns them. But I remember like they would bring all the management in on these higher level meetings and they would have the CFO come in. And this is like a Fortune 50 company, and like they give us privy to all these data and stuff like that and these charts, and then like we would have these things in our head like when it goes up we're going to get to this 110 price if I just hold on to 85 right now, and I'll sell at my RSUs or my stock options at that point. And looking back, it was just a bunch of corporate propaganda. It's like you feel like you have an insider advantage. You don't. It's just the nonsense that they're telling you to keep your stocks, or more importantly work harder for the company. But I'm a little jaded, of course, which is why I don't have a day job. But yeah, it kind of brings us to the next topic, right? Because you advise on not only exiting the company and all this type of stuff, but also getting into negotiating the salary and compensation. What's some of the common tweaks that you'll see people will make based on your advice?
I don't specifically advise on what people should do in terms of, hey, you need to get this number or that number. We leave that up to more likely an employment attorney. But when they do come to me with an offer, I want them to be comfortable with what they're earning, what they're compensating. And a good way to look about that is to compare what's going on in the market. Are they being compensated fairly for that position at that size company at that point?
I think I'm the outsider. I don't know anything about tech companies, but what I noticed, there's usually a paradigm shift for people that are under 1.5, $2 million net worth. For those people, just to use up two binary options, it probably makes more sense to take a little bit of risk within your career and go to the smaller company. Once you pass that amount, you have enough critical mass to just invest passively. You got $1 million at 12%. That's 120 grand right there. Most people listen to this channel are pretty frugal and they can live off 10 grand of passive income a month. Therefore, go work at the retirement home called Microsoft. Sorry if you work at Microsoft, but if you probably think that's funny. And then you don't need the RSUs or the startup type of stuff. But to me, when I talk to people, that's usually my high level advice at pushing them one way or the other. Of course, there's in betweens.
I think it comes down to risk appetite. A lot of people who work at startups or tech companies are what I would call risk seeking. They want that risk in their life and their investment portfolio and their career. And that's what they're comfortable with. Whereas if someone's looking at something a bit more steady, a typical payment every quarter, every month, they're probably not as risk aggressive in their style or their lives. And either approach is fine. It all depends on the person, because at the end of the day, your personal finance is personal.
Exactly. And I'm glad we got to hear this in this conversation, the philosophical discussion about risk. What normally people do is the opposite. It's asked backwards. The people who are broke are the ones that don't want to take the chances and wants that steady paycheck. And it's the people that gotten past that $2, $3, $4 million net worth, want to have impact in the world and don't care what paycheck they're getting. And there could be two inflection points, perhaps. So maybe at $2 million to $5 million net worth, they do want to go and work for more of that steady employment. Certainly when you get past 5 million, especially when people are getting older, I think like into their 50s and they're still working at that career, there's a reason why they're working in that career. If not, they would have pieced out a long time ago with $25,000 of passive income every month. But at that point, they go more for impact and they want to be part of a smaller company and change the world, right, in their own unique way. But yeah, it's all personal, right, Ben?
It's very personal, and a lot of that depends on how a person grew up. What were their parents like? What was their hometown like? What stories did they hear about money from their friends or their teachers? And all of that is really powerful, especially during childhood. And a lot of that lives in people's subconscious. They don't really realize their behaviors around money. They just do it because they've been on autopilot for such a long time. And I think it takes a lot of time to reflect and think about what it is. What does someone value as to how they spend their money and how they invest it?
Yeah. Any in your travels talking to people, any anecdotes that come into mind that kind of this was probably best for them and their family, but for some strange reason they wanted to go down this route or did this, and maybe you had to intervene and show them the blind spot?
Yeah, there's definitely been a lot of stories where clients come to me with very large positions in their employer stock. And I tell them the stories about, name it, Enron, Lehman Brothers, et cetera, and how a lot of those people were left with nothing. So it's a lot of coaching. It's a lot of change. I'm trying to change people on their behaviors around money and eventually get them to set up a program where they're selling off their concentrated positions in the employer and then reallocating that into more broadly diversified investment portfolio.
Yeah. What you put your money into, that we're not going to be covering that today, obviously. It's, if anything, similar to the whole idea of a lot of people come to me and they might have half a million at least in their 401ks, which I'm not a huge fan of. That same concept, leaking it out of there slowly to mitigate your AGI exploding on you, can be done in infinite amount of ways.
We could talk about that a little bit in terms of the 401 and obviously 401k can't be drawn on until you're 59 and a half years old or older. And when someone's in retirement, they're generally not receiving any sort of income because they're no longer working. So the way that works, there's a thing called an RMD, which is a required minimum distribution. And it's a table that's set up by the IRS, and it deems, okay, like you're this age now, this is your life expectancy. We're going to divide how much money you have by the amount of years you have left on this earth. And you take that out each year and you're taxed on that as ordinary income tax rate. Clearly, that's a tax deferred vehicle. And there are other vehicles that are tax free that can help people in retirement, such as the Roth IRA.
And I also think that people coming to this point, they're typically good employees, good at their job, and they're typically not the best investors nor financial planners for this type of stuff. And another good maybe tool would be deferred comp, setting yourself up, especially if you're sunset years of your career. What it does is it buys you time. It's like punting the football in the future to not just take it all now and blow up your AGI super high so you're in the 37% plus tax bracket, but it buys you some time and maybe allows you to leak it out, as Joe mentioned, like similar how maybe a 401k throwing it in there a little bit and then leaking it out in the years. Of course, you got to remember about those RMDs at the tail end, which is another constraint. But yeah, good problems to have.
Yeah, if you're worried about bumping tax brackets in retirement, not a bad place to be.
Yeah. But yeah, anything else I think topics you think we need to cover before we wrap up here?
Yeah, I really think that when people are thinking about their ownership in a company they work for, they should really reassess how that impacts their overall financial picture, not just their portfolio, but thinking, okay, I have all this stock. If I sell some of it off, I could actually put a down payment on a house or pay for my kids' college tuition or any other sort of financial goal that someone may have. So there's a lot of ways to use equity ownership to your advantage.
I guess before we run off, I've got a lot of equity as general partners, and that's me why I'm poor, right? Because equity rich, cash poor. But similar to people with a lot of RSUs, are there any third-party banks or institutions or third-party people who will take that and evaluate it and give some kind of like a way a HELOC, but like an equity-based line of credit or something like that? Or are there any type of those tools out there?
There are companies out there that will either buy your shares at a pretty deep discount, and these are for shares that are not liquid. They're privately held companies, so they will buy them at a deep discount. Or there's other ones that will actually pledge your shares to them and they'll give you a loan on the shares. I'm not sure how the market's doing nowadays. That was all the rage a little while ago, but I would imagine things have shifted a little bit given the change in markets and the overall economy over the past year.
Yeah, bankers and entrepreneurs, all people that like for people who have LP positions and syndications, say the infrastructure exists, although they're not very good options because on the one where you're buying out your position, they're usually going to sandbag you pretty heavily on the evaluation. They're here to make money, not here to help you out. And then the other one that Joe mentioned, the second where they're giving you a loan and the interest rates on that are pretty high and they will still sandbag the evaluation on that to cover their protection on there. And I haven't really found any good options that are really that advantageous unless you're desperate to get out, at which part you're going to take a haircut. But that loan one is better out of the two because it's non-taxable event, just like you take money out of your HELOC or your house. The other one, if you're selling it, that now becomes a capital event. But no, but would it be a bank or is it like a website for that for people to check out?
Most banks don't do that. There are some companies out there. I don't want to mention any names.
What would they Google? What do you call this? Like equity, company-based equity sales or
yeah, like liquidity for privately held startups.
Okay. Or liquidity for RSUs.
Well, RSUs will be liquid because they're in a publicly traded business. But these sorts of loans or you're selling your shares are for privately held companies.
Yeah, but definitely an option. It is a problem that people with that many RSUs are in the highest tax bracket. They're making $400,000-$500,000 already, and to them to take any dollar more, they got to pay 50 cents in a dollar. Essentially, that a loan on that might work, even if bankers are sandbagging the value on them. Yeah, the strange world of bankers that we live in. But thanks, Joe, for jumping on.
You're welcome.
You want to give your website out there for people to get a hold of you in case they are running into this good day of windfalls ahead?
Yeah, of course. My website is Fortrove Partners. That's FORTROVE partners.com.
Yeah, folks, and thanks for listening. I know this good problem to have has come up several times. Nobody has bought me a free beer when they've exited. I always just get an email saying, "Yay, what are we going to invest in now?" But yeah, I figure a lot of people might be having the same problem out there, and we'll see you guys on the next show.